The Business Advisory Group presents a webinar series, Surviving, Thriving, and Growing Your Business Through the Pandemic. Each of these webinars features New England Provisors members. The Business Advisory Group connects professional expertise within the Provisors Network with the resources that business owners need to improve the value, efficiency, and profitability of their businesses. Each of the sessions, starting on September 29 and continuing through November 18, feature provisor experts in each of the categories noted. All of the sessions begin at 2 p.m. Eastern and will be rebroadcast over our YouTube channel. We hope you enjoy the sessions and contact each of the experts if you have questions that are important to you as a business owner. Thank you.
Good afternoon, everybody, and welcome. I'm Dominic Grew, and today's moderator, a member and co-founder of the Business Advisory Group, along with my partners, Warren Rutherford and Lee Adelson. Just a little bit about the Business Advisory Group. Our mission is to provide resources, knowledge, and expertise to our network to help business owners survive, thrive, and grow during the pandemic and beyond. In today's session, our topic is talent retention and business succession. And just before we get into that, just a few quick suggestions. One is, on the top of your screen, under the view options, we suggest that you uncheck side-by-side mode and then set the zoom ratio to window. We ask that if you've got any questions, please put them in the Q&A box. We'll try and hit them as we go along in our session. And then just a final reminder that the session is being recorded. Before we begin, I'd like to just have our panelists introduce themselves, and then Warren Rutherford, our co-host. I'd like, Warren, if you could introduce yourself at the end as well. So why don't we start off maybe with you, Jesse, introducing yourself.
Thanks, Dominic. My name is Jesse Angeley. I'm a business law attorney with the firm McLean Middleton, and I'm based in our Woburn office at the Trade Center. And my practice focuses predominantly on advising businesses and business owners on a wide array of issues, including business succession planning, asset and stock purchases and sale transactions, as well as serving as outside general counsel on a number of other issues, sort of general corporate matters and so forth.
Well, welcome and thanks for being with us today. Brad?
Thank you, Dominic. So my name is Brad Taylor. I'm a partner here at Markham in our advisory services division. I specialize in business valuation for both private and publicly held companies. I perform valuations for a number of purposes, gift and estate tax planning, corporate advisory work, family law, so divorce and some litigation shareholder disputes. I testify in court. Corporate advisory can include management planning, M&A transactions, stock options, and intellectual property and tangible assets. So thank you for having me today.
Thank you. And Lee?
Thanks, Warren. Warren and Dominic, good to be here today. I'm Lee Adelson. I'm a financial advisor with the Bullfinch Group. I provide uncommon thinking to create uncommon results for business owners by implementing insurance strategies to attract, retain, reward, and key employees, as well as during their transition due to growth, sale, succession, and retirement. Thanks for having me.
Terrific. So that runs out our three panelists. Warren, would you like to introduce yourself?
Thanks, Dominic, and welcome to our panelists, a well-rounded group of individuals, and I'm looking forward to the session. I'm Warren Rutherford. I'm the owner of the Executive Suite. I provide talent assessment systems, executive recruiting, and executive coaching to small and medium-sized businesses.
Terrific. Thank you, Warren, for all the magic you'll be working there as we go through our discussion today. As mentioned earlier, I'm Dominic Grew. I am the owner of Elevate Business Coaching. I provide business leaders with the outside perspective they need to manage change and accomplish their business and their career goals. So let's move into what we're going to talk about today. So we are going to talk about business succession, what documents are needed and why they're important. Jesse's going to be talking about that. Then we're going to be moving into business valuation, the importance of knowing what your business is worth. And then finally, business succession and executive benefits, providing cost-effective strategies to protect your business. So there you have it, folks. That's what we're going to be talking about. And this particular topic, it's tricky just to kind of jump in, at the deep end. So I wanted just to take a moment kind of to set the scene a little bit before we get started. So imagine you're a business owner and you've worked a lifetime creating your vision of what a successful business is. And you've worked diligently at building a customer base, a client base, and fostering those long-term relationships. You've had bumps in the road for sure, but you've always found a way to recover. And you've had growing pains, but you've always found new opportunities as well. You probably built a great team and you've been able to have the business operate smoothly. You probably have, hopes to retire one day. Not quite sure maybe, when that's going to be or how, etc. But you're really thinking about, the next chapter of your life, handing the keys over to the next generation and the legacy, keeping that going for generations. Or perhaps you're thinking about, transitioning the business to another buyer. And then all of a sudden, something like what we've just gone through hits, the pandemic. And, we all ask our questions, we all ask ourselves that question, how prepared are we when threats and challenges come up? We've had some of them before with the global financial crisis. Maybe we've had, others in our business partners who maybe have passed away unexpectedly. And you probably spent, boundless hours working in your business, and maybe not so much or neglected a little bit some of that time spent working on your business. So what we're going to do today is just really give an overview of the, the critical key components to achieve just that with the experts that we're going to be talking to now. So, as a business owner, where do you start in addressing all of these important issues? So kind of having set the backdrop there, I'm going to ask Jesse, you're going to be up first, and just kind of open with that question about, what does business succession planning look like? And what exactly is a business succession plan in practice? So Jesse, take it away.
All right. Thanks, Dominic. So at its very simplest, business succession planning is a series of operational and financial decisions of a business owner about who will take over the business upon certain triggering events, an exit. Often it's referred to as a business prenup or a postnup, depending on when it's signed between business owners. And the common triggering events that are most frequently addressed in some form of buy-sell agreement or shareholders agreement in a business succession plan are death, disability, and these are all of a business owner, retirement, divorce, disqualification, and expulsion from the company. That really arises more in the context of businesses that require professional licenses or regulated professions. Early withdrawal, so sort of voluntary withdrawal. I want to get out before some other triggering event. And then another one that I don't have there, but is often addressed, sort of a category of involuntary transfers, and those would include transfers upon insolvency or bankruptcy of an owner, of a shareholder. Why plan? Why is it important to go through this exercise, early on, maybe many years before you want to retire or something along those lines? Well, first, it's really important for a business owner to be able to monetize the value that they've built into their company upon an exit, and putting in place and really implementing a business succession plan will allow an owner to exit from the company on his or her preferred terms, and hopefully that owner will be able to get the fair price or the desired price for their ownership in the company, and hopefully that reflects all the years of sweat and tears that they've invested into building their business and helping it succeed. It's important to have a plan in place before certain triggering events happen, because it might be too late to sort of, figure out the best way to do it once these events have happened. For example, death or a crippling disability of an owner. That's not the time to go through a process of thinking, hey, what's the best way to have my shares bought out? There are a lot of the dynamics of the relationship between the owner who is going to be bought out or is exiting and the other business owners may have really changed at that point. So you need to do it early on when everyone has sort of a level head and is thinking about, hey, this isn't something that's going to happen right now. What do we want it to look like in the future? Some of the succession techniques that Brad and Lee will talk about in a little while require some advanced planning to implement, such as a business valuation, grooming key employees. If a succession plan involves selling to your key management, and also ensuring that you're transitioning critical business relationships. An exiting owner should want the business to continue to succeed after he or she exits. And certainly one of the more important ones is having a succession plan in place will really hopefully avoid disputes between owners and maybe family members, depending on if it's a family business or not.
So if I'm just sorry, just to interrupt, what I kind of take away from what you just said there is it's called a plan for a reason. It's not something you want to be doing in a reactionary format. You want to be doing it before you actually need it. And I was just curious, like when's the best time to do it, ideally?
I think the best time is now, or at any point. I guess maybe a better way to answer that is when isn't the time to do it? It's not time to sort of put in place, a comprehensive, well thought out business succession plan at the time somebody is being bought out. Yes, it happens all the time, but what we're talking about here is doing it in a really methodical way. An approach that so it's not a rush right at the end.
Right.
So sooner the better. That said, oftentimes it's all sort of fleshed out, and the terms of an exit aren't agreed until right when somebody wants to exit.
Got it.
So there are 5 common ways to transfer business ownership to other co-owners. Of course, that's assuming there are other owners. To key employees, your key management employees that you've mentored and groomed and hopefully will want to take over the business. To your family or heirs, whether it's first generation business, so it'll be the first transfer to your family, or whether it's an ongoing family business. And just a point on family business succession planning, that can be a webinar in and of itself. I mean, there are a lot of different factors to consider and dynamics dealing with family businesses. So I'm not going to get into too much detail on that, other than to say there's a lot that goes into family business succession planning. To an outside buyer, and that's a little bit different than most of what we're talking about today. Most of what we're talking about today is sort of business succession amongst business owners or to other employees. And then finally, to the company itself through a redemption. And again, that's usually available when there are other owners in the business, not just a single. There are really 3 critical components to a good business succession plan. It needs to be properly documented, and that can come in a number of different forms, but usually it's some form of buy-sell agreement or a shareholders agreement, or for LLCs, it would be an operating agreement. Sometimes they're called stock redemption agreements if the redemption is the path that owners have decided. You need to be able to have, a good procedure in place as to how the value of the business will be determined for purposes of an exit or a buyout. Whether it's going to be appraisal or valuation, and Brad's going to talk about that process shortly. Whether it's an agreed value, that the owners agree on a value every year, 2 years or so, or whether the owners agree on a formula to determine what that value or that price, the buyout price, will be upon an exit. And then the other critical component is the plan properly funded? And Lee's going to talk about this more, but a good plan should have, should spell out how is it going to be paid for. Is it through life insurance or key person disability insurance? Will it be through seller financing, through a promissory note? Will it be commercial financing involved? Some form of earn-out type structure. So that's really important to include in the plan as well. From an actual documentation perspective, as I mentioned, usually takes the form of a buy-sell, shareholders agreement, and similar to buy-sell, usually a little bit more robust, covers additional topics. And for an LLC, it's usually an operating agreement. But the most important thing when it comes to documentation is that you actually have it documented. It's properly executed, meaning everybody has actually signed the agreement, and that the document or documents are updated or amended over time as needed. For example, if new owners join, they need to formally join the agreement to become party to that contract and be bound by its terms. If there's life insurance or other insurance in place, and it's scheduled or attached to the agreement, that should be attached and updated, and those policies need to be maintained. If there's been significant change in the nature of the business, then maybe that's time to revisit the document that you have.
Can I just ask you a question there? So clearly you need to have a plan. It needs to be documented. Ideally, you want to have done this when your business in a state where emotions aren't high. You're not in a crisis situation, so it needs to be planned. But what you're saying there, as well, is that's not enough. It's got to be reviewed on a periodic basis. Can you give some guidance as to how often should somebody be reviewing their the documents, the plan?
Sure. I mean, I don't know that there's any set in stone answer. It depends. More often than when they sign it, and then when somebody wants to exit and you want to implement it. It depends in part also on the valuation formula or the purchase price. One of the methods I mentioned was an agreed value method, where the owners agree on what the value will be and establish that value for purposes of a buyout for the coming year or 2 years. So at least in that situation, they should update that and in accordance with that time period. But every few years, barring some sort of event that has occurred that would prompt a more frequent review. But I would say every couple of years would be a good frequency.
Okay, cool.
Jesse, I've got a question from the audience. And it may seem obvious, but maybe not. What's the downside of not having a business succession plan in place? I mean, what happens if you don't have one of those?
Sure. So, it'll depend a little bit on what the triggering event is for an exit. If it's somebody who's just ready to transition out, retire, then some of these options are still available. They can still go to a key manager or managers and approach them to see if they're interested in coming on board. And the details of that buy-in by those key employees would be dealt with and agreed at that time. Another option would be if you're going to sell to a third party. Of course, that's another option that would be available, and the details of what that purchase would look like would be negotiated at that time. Some of the more concerning situations when there isn't a plan involved would be death or disability. If an owner passes away, then the owner's estate usually would become the shareholder or the owner, depending on how the stock or the membership interests are held, or a trust. Again, depending on how it's held for state.
And just, I know you've got more to go here, but the follow-up question from the audience is, how long does the business succession planning process take?
Sure. Again, it depends. I know that's a lawyer's favorite answer. It depends. But oftentimes this is a process between business owners in which they sort of we talk about what they'd like to do. We put together a shareholders agreement. They look at it. It's an iterative process. We go back and forth and make some tweaks. I mean, it could be done in a few weeks, or there have been times where it's taken 6, 9, 12 months to get something from start to finish, to execution. It really depends on how quickly the client wants to move, how quickly they provide us information to build out the agreement. All right, great questions.
Thank you.
Quickly, a couple different purchase structures for buyouts. There's the cross purchase. That's when co-owners buy out the exiting owner. It can get a little complicated if there are a lot of owners involved from a mechanics perspective. Also, if it's being funded by insurance, the more owners, the more insurance policies that need to be in place for buyout purposes upon death. A redemption, that's again when the company buys the exiting owner out, and then a hybrid, which is a combination of both. Both the company and the other owners have the option to buy out at that time. Briefly, this is what Brad's going to talk to a little more about. Business appraisals, evaluations. It's a very common method to determine the value of the company for buyout purposes or sale. And you really need to get somebody who's qualified and has experience with your type of business and that industry. And an appraisal or business valuation report can serve a number of functions. It could point out a few areas where the business could improve its operations to increase the value down the road. So Brad will talk a little bit more about that. And then lastly, taxes. Almost any transfer will have some form of tax ramifications or considerations. And it takes some time to really structure a plan so that tax ramifications are managed or limited. So this is just a plug that the CPA for the business or owner should really be involved from day one during this planning process and throughout the process, and importantly at the actual exit event. So that's what I have.
Awesome. I want to just ask one kind of final question as you've been talking me through that. There's a lot to this plan. There's a lot to think through. It's got to be kept current. And I'm sure sometimes people think that their plan is current and maybe they find out that it's not. But just curious, in this environment, are you seeing like an uptick in inquiries around this from businesses where, they're circling back on some of these things that maybe they put off in the past, or maybe they haven't looked at for a while? Are you seeing an uptick in owners looking for these documents?
Yeah, a bit. Certainly with COVID, I think a lot of owners have come to realize that maybe they really do need to have a plan in place because they might get really sick and be unable to function or serve in their role in their business, or God forbid pass away. So that has driven some additional inquiries, but that's also been balanced with the fact that businesses have really been impacted by the economic downturn. So clients want to conserve capital. So there's been more discussion. Hopefully clients will begin to actually put these plans.
Terrific. No, thanks. Thanks for sharing your perspective. It was just something I was thinking about as you were talking. So we've talked about the legal side. What I want to do now is switch a little bit, look at the valuation perspective and all this. So I'm gonna kind of pass it over to Brad Taylor to talk us through that.
Okay.
So Jesse, I think you just need to stop share, and then there you go.
Yep.
Thanks, Brad. Great.
So
thank you.
Jesse had a couple really good points, and there was some good questions on things, why plan. So value to anybody is really, the value is based upon future expectations. So if you're looking at your company and it's a mature company and it's growing consistently, you have an understanding of what that value may be after you go through some some machinations. If you have a high growth situation, it may be a little different. So, the why plan is to get an understanding of where we're starting. We want to start as early as possible to have an understanding of, I'm retiring in 5 years. I'm going to need $10 million for my financial planner to continue living the life that I and my spouse have become accustomed to. If you wait until the last moment, and let's say the business is your largest asset, if it goes out to market or management buys it and they say, oh, it's worth $6 million. Now you're not going to be ready for your lifestyle. You won't be able to keep up with the lifestyle that you're looking forward to. So it's really important to get that understanding early, because as Jesse was saying, you could start planning. And I have some slides in a little bit where we talk about some of the things you can do, but if 3, 4, 5 years before you plan to exit that you need the value to go up, you have time. And time there is your friend. Whereas if you wait until the last moment, it's going to be very difficult to increase the value of your business. So Valuation 101, the value of any business is a function of 3 different pieces: the cash flow generation capability of that firm. So not just revenues, you can have a lot of revenue with very little cash flow, or you could have lower revenue and higher cash flow depending upon your profitability. So we look at cash flow at the end of the day, not revenues or other estimates, and some people will, but it's really about cash flow. The other thing we look at is growth. So as I said earlier, if you have a very mature business, that growth is going to be low. If you have a very fast growing business, that growth is going to be very high. If the growth of your cash flows and your earnings is higher, you would expect the value to be higher. So those two go hand in hand when we're looking at a value. And then there's risk. So Jesse had mentioned earlier about key man risk, key man insurance. Risk could be a function of many things. It could be simply one person really has all the customer relationships. What happens if that person, God forbid, is hit by a car tomorrow? What happens to the estate or the business if there were no plans beforehand, as Jesse had said, death? This all comes into consideration when we're considering and we're performing a business valuation. So why do you need a valuation? Well, we do valuations for a number of different reasons. Tax reporting, so gift and estate tax, wealth transfer, charitable contributions. These are all things that need to be done for a regulatory purpose. So we will value companies when you want to give shares to your children, let's say. Part of a transfer of ownership, as Jesse was mentioning. So you're building that succession planning when it's a family-held business into your planning, tax, valuation, and everything else. Wealth transfer, charitable contributions. These are all tax-related purposes. I'm going to skip the second one here. Business planning, that could be an exit for an M&A transaction. It could be an employee stock option program where the employees are going to buy the company. So that goes into more of a management buyout. So again, thinking of transitioning the business and succession planning. It could be a buyout of an individual shareholder. Intellectual property, intangible assets, patents, trademarks, copyrights. All of these things can be valued, sold, transferred. Those are more of a corporate planning. The second one, equity incentives to key employees. To go back to what Lee and Jesse and we're talking about today, is if you're looking to incentivize your employees, issuing stock options. In order to issue a stock option, you need to value those shares to make sure you are not issuing stock options that are already worth more than what the person receiving it would have to pay. That you would actually have a tax issue there with the IRS. It's called a 409A valuation, 409A tax issue. But you want to incentivize those key employees, and what better way, A, for them to become part of the company, B, to incentivize them to help grow the business. If you remember, we talked about cash flow and growth. Get them involved because they may be the driver of that growth. Fourth down here, cash flow value protection. SBA loans, sometimes valuations of your company are required for loan purposes. Business interruption insurance, expense measures. These are all more business planning ideas. And then litigation. So it could be a divorce, as Jesse just mentioned. That factors into protecting the business, and whether it's for passing it on to your children, to management. Having those things in place helps to ensure the business will hit as few hiccups as possible when it goes through its life cycle. So factors to consider when we're looking at evaluation, and this happens in all valuations, things we consider will be the nature and the history of the business. What has been going on in this business? Has it had its ups and downs in revenues and earnings? Is there key people leaving? Is it a technology company with patents and trademarks that are properly protected? So trying to understand the business itself and what is driving that business and what the goals for that business are is very important. The economic outlook in general and the specific outlook for the industry. Again, to go back, if you're in an industry that's growing at 2% a year and you think you're going to grow at 10% a year, well, we're going to ask, where's that growth coming from? How is your business capturing market share at that point? Or if you're in a business that's growing, industry that's growing 25%, and you think you're only growing 3%, well, this is where we could start talking about that planning. Well, why? If you know 5 years earlier that you need to increase the value of your business and the business industry is going to grow highly and you don't expect high growth, you can start planning on how do I capture more? How do I grow more in line with the industry? Do I need to build out my management team, sales team? Is my product dated? So this can start helping you in that planning process so that in 3, 4, 5 years, you can reach your goals. We look at the financial condition of the business and the book value of the stock. So how is a company actually performing? Are you growing? Are you high profit margin? Are your profit margins shrinking? And we get into even looking at how your cash is going. Are you paying your receivables faster than are you collecting your receivables faster or slower than collecting your payables? Getting into cash management. Cash is king. Cash management is very important when you're looking at how the business is operating, which again gets back to what can you do between now and then? Maybe you can make that improvements in how your cash is being funded and worked within the business. Earnings capacity. So what is the outlook? I spoke a little bit about that. Often in family businesses, you may have 2 or 3 people in the business and 2 or 3 people not in the business. What is the dividend paying capacity? Will that impact who wants to be in the business? Could it lead to, Jesse had said, sometimes there's family issues and you could have a whole, webinar on family dynamics, but, are you going to, let's say in your estate plan, take into consideration where kids and grandkids are getting cash and how that is going out? Existence of intangible assets, not only their existence, how it's impacting the business. Is it driving revenue? Is it decreasing costs because you have a competitive advantage? If, let's say it is driving revenue, what happens when that patent expires 3 years from now, 4 years from now, 10 years from now? Trying to understand, again, what's driving the business. We'll look at sales of stock of the company that have been either sold or transacted. What were they? Who was it with? Was it arm's length? Was it negotiated? Sometimes you'll see someone say, well, my best friend gave me $100,000, so I just gave him 10 shares. Well, but what does that really mean? Is that really the value of the company? And then finally, we'll look at other companies in the industry who are publicly traded. And we'll look at those companies and say, their margins, again, to get back to what I was saying, their margins are 25% profit margin. Yours is at 10. How do we improve yours so that 3, 4, 5 years from now, your value is where it needs to be so you can go off into the sunset and play golf or travel or do whatever you want to do, and the business goes on and the business succeeds, if that's the plan. I mean, as I think Jesse said earlier, sometimes, let's say, children don't want to be in there, so you have to go outside. But again, looking at what the outlook of the business is.
Brad, I've got a question from the audience about the intangible piece, the goodwill piece. The question is, how do you factor in to that whole evaluation process, the marketing and sales strategy and the business plan of the company?
So all of that comes into consideration when we look at the business itself. So when we're looking at the business, the nature of the history, marketing plans, growth, that all comes into play there. And it really comes in when we're looking at a forecast, if the company does a forecast or a budget. And again, that goes into your growth. So let's say it's marketing. Are you marketing to where you need to be? Is your sales force where it needs to be? It's difficult to say for evaluation that if you spend $100,000 on these ads, it'll translate into X number of customers. That's not really what we would do. There are market research people who do specific points. But in terms of marketing and sales, if you're not doing it and you're not growing and your industry is growing, maybe that's why. So we talk to management, we'll interview management, and we'll get an understanding of that sales cycle and try to say, what we think is going on there. Yes.
Thank you.
So Jesse spoke about having the documents updated regularly. And the thing to remember for valuation is at a specific date, what we may call the effective date. And the importance in this is that if you take something that was done 5 years ago and you apply it to today, the business might be very different. The industry might be very different. A good example of this is I was doing investment banking in 2001. And the company I worked with did a lot of work in the aerospace and defense industry. If you had written a document that said, we're going to buy you for 8 times these earnings in the summer, it probably would have been a good document. September 11th happened, and 3 years later, when I left that firm, those same companies, those industry participants were trading at more of an 11, 12, 13 times that same earning that same earning measurement. So sometimes if you just sit on those documents, it's almost like you're playing chicken with, let's say, your partner on who passes away first. You could either be a big benefit or you could be the loser in that transaction. So it's really important to have them updated, those documents updated yearly, 2 years, 3 years, just enough so that you're familiar with it, but also so the people involved in it are familiar with it. We see quite a bit of litigation where there'll be, a mathematical formula and something happens and then the parties sue because they're saying it's not fair market value. They've never seen the application of that formula before. They read the shareholders agreement and just signed it and didn't really have a thorough understanding. So it's important to make these documents flexible to grow, timely, and have something which is allows that document to be shared and spread out so that everybody has the knowledge of how these things are going to work. And the key here is the effective date. You only consider what's known and knowable. So we're seeing a lot right now where evaluation date may be late December 2019. And this litigation, some gifting is going on or was going on. And people say, well, COVID's happened. My business is down 30%, and I'm making up a number there. How are you factoring that in? And if you're using a time in 2019, you really can't. It's not known or knowable as of that valuation date. So that's why it's important to at least look at these documents, consider updating them or having them be, flexible enough that there's some wiggle room and you have those discussions regularly. So valuation approaches, and I know I'm running out of a little time here, so I'll be quick. The asset approach is basically saying, we're going to look at your assets, we're going to look at your liabilities, and the difference between the two is the value of the company. That's typically considered the floor because there's no growth built into that. There's no risk built into that. If you remember, valuation is a function of cash flow, growth, and risk. The market approach looks at either public companies or transactions of similar companies. My neighbor sold his company for 1 times revenue, and his company is exactly the same as mine, so my company is worth 1 times revenue. The income approach looks at the cash flow generation capability, looks at the growth of that. It's a better way to value if the business can give you some information here. Often forecasts or projections aren't done on a regular basis. We can help, we can work with the company, but we often see either the market approach or the income approach. And you can use all of them. All of the approaches should be considered in evaluation. They may not all be used. You can use most of them, but at the end of the day, you want to reconcile these methods so it makes sense. I've seen somewhere, kidding you not, 3 approaches were used, $500,000, 18 million, 21 million, and they averaged the 3. So what that basically is saying, you have as much chance of being worth $21 million as you do 500,000. Something isn't right there. So you want to reconcile the various methods.
So Brad, I could listen to this stuff all day. It's so interesting to me how you put a value on these things. The one thing that I'm hearing from you is, there's a number of different ways to do this, lots of different methodologies, but timing's a big factor. And if there was ever a time for, there's an example in point, it's right now, how much the world has changed in this past year. And there's no doubt that, it applies positively or negatively, but it's all situational. Like to your point, Jesse, it depends, right? But great topic. But I do want to make sure that I get time to get over to Lee. So, and again, if there's questions on anything that Brad and Jesse have talked about, just put them in the chat there. We'll try to get to them by the end. But with that, I want to kind of hand over to you, Lee. You're going to talk just a little bit about, what's your involvement with owners of family-owned businesses. So if you want to just take it away. You're on mute, Lee.
That pesky mute button. All right. Dominic, you mentioned it earlier that, a business owner works hard over the years and puts in, countless hours to make their business successful. And, the business provides income to support their family and their household. And in many cases, depending on marital situations, it supports other households as well. So my role is to work with a business owner to protect that asset so that if something does go wrong, the business owner still provides support to the business owner and their families. And, for me, this is a personal thing. My father and my brother were in business together. And, when my father retired, there was no agreement. There was no signed documents, no money changed hands. So my brother got the business. My father stepped off into retirement with no money in his pocket, and it didn't really help his retirement quality of life. So he really didn't get anything for his life's work. And my role as an advisor is to work with my business owner clients to help them understand the consequences of not planning, and for me to help them make sure that they can maximize their value. So they have assets to protect. And there's several assets in a business that need to be protected. And there we go. Uh, the business is more than just products or services that are provided through the business. It's really the key drivers are the business owners, the partners, the key employees that really are the driving force behind the business. Think of it as the goose that lays the golden egg. You protect the goose, and those are the important factors that come into that. So, those are the things that happen that you want to make sure that they're protected in case something goes wrong. And, as Jesse said earlier, what are the things that can go wrong? Jesse mentioned, the death or disability of a business owner. A divorce can adversely affect a business. Retirement of a business owner, loss of a key employee, whether they die or they become disabled, or they get hired away, they leave on their own, that can adversely affect a business. Professional license, Jesse mentioned this earlier as well. If you're a doctor, you're an attorney, you're a CPA, you're an architect, you're an engineer, anything that requires you to have a professional license is going to be a real key problem that can adversely affect that business. And legal issues, lawsuits can also be effective, that can adversely affect a business as well. So when it comes to, buying out an owner in a business in these circumstances is really, without planning, is going to be financially devastating or nearly impossible to do. And, as Jesse mentioned earlier, the agreements must be in place in the event of a business interruption or a business divorce. And as he said, think of it as a business prenup. In this way, having those documents, you've got a roadmap on how to navigate these issues. However, without the proper funding of these agreements, the legal documents aren't as strong as they're intended to be. And in many cases, I find a business owner may not have taken the first step. And if they do, they may forget or delay signing their documents, which happens more often than people think. To put it in football terms, they're at the 5-yard line and they fumble the ball. They're really not effectively making those documents work the way that they're supposed to. And properly funding those documents is going to allow the business, as it were, to score and protect and lead the value and protect the value of their business and keep the business successful from that standpoint.
So Lee, I like that term that you put. I was just taking notes as you were going about protecting the goose that lays the golden egg. I like that one there. And you talked about it being a prenup, which is like this common theme. You don't want to wait till something happens. You want to plan for it, in advance. So great stuff. Sorry, I just thought I'd pipe in with that.
Yeah, exactly. Well, there are ways to fund these agreements. And, I want to go over that a little bit. When it comes to succession funding, there are 4 basic ways to do that. A business can create a sinking fund, which is basically setting aside funds that are not part of the operating capital of a business, that are set aside specifically for buying out a business. That's tying up a lot of cash. You can have a loan, you can borrow money to buy out a business partner. Again, it can be a little bit expensive depending on terms, and an installment sale may take time. This is something that could be written into the agreement based on Jesse's terminology in a succession agreement. And lastly, insurance. Insuring against the loss of an owner, a key employee, can be a very valuable aspect to that. So, those are the 4 basic outlines from that. And, each of these plans has a cost, and it's understanding which ones are most effective. And, the valuation that Brad outlined earlier, as he discussed, should be part of the agreement so that you can understand how you're going to fund these agreements. And if they're not in place, if they're not fully complete and included in a document like Jesse outlined, you can have significant problems. And, that these obligations may require an immediate funding of an agreement or a series of payments over time. And that can be very difficult to accomplish. So, if an immediate payment is needed, that a business owner's spouse that's inheriting their share of the business needs to be paid out. Let me use an example of $500,000, make the math easy. In order to generate $500,000 and a business is running a gross profit of say 10%, they need an additional $5 million worth of sale in order to generate that amount of money to immediately pay off that deceased owner's spouse that's inheriting their share of the business. That's before salaries, rent, mortgage, any employee benefits or overhead that are done. So it comes right off the top. That's an expensive expense that a business has to happen. And if it's the pandemic, when sales are off or non-existent, if there's an economic downturn, if competition reduces your market share, those are adversely affecting. They can undermine the overall future of the business without having the proper funding. That's probably the most expensive way that those things can happen. Thinking about the most cost-effective way to buy out a deceased, a disabled, or a retired owner's share is with life insurance or disability insurance. And that way, an owner's business is not adversely affected from cash flow. An immediate amount of influx of cash can be used to buy out that deceased partner or disabled partner's spouse, and the business can continue to go on without interruption. And they can be bought out, again, relates to Brad's valuation and how that can work, that the numbers are already established based on the formula and according to favorable terms and agreement from that standpoint for a business. Insurance is typically considered, buying a dollar for pennies on the dollar. It's the most cost-effective way to use that. And that's usually very easy to do as long as everybody's insurable. Small minor issue, but insurability can be a problem. Now, you have an owner can be a key employee, and you can have key employees that also contribute to the success of a business. So sometimes a key employee may be in line to buy the business, and if either of them are lost, revenue can adversely affect. There's a loss of revenue, loss of relationships with client accounts, suppliers, manufacturers, supply chain can also be adversely affected. Profitability is obviously going to go down. If you've got a banking relationship and you've got a note out there, in that case, a bank may call the note. And that could be an immediate need for cash as well. So again, these threats to making sure that you can provide immediate cash in the event of an unexpected event is really key. And again, the most effective way to do that is life or disability insurance on a key employee, and an owner is typically considered a key employee. That's also important. This way, coverage can provide the funds to hire and train a replacement or two, depending on how valuable that key employee is. It may take 2 or 3 people to do that job of that person. It also can compensate for the loss in revenue that may be lost from the loss of a key employee. You also have cash in a policy, depending on the policy design, that can also be used as a benefit there. So those are important as well. I'll stop there for a second and see if anybody has any questions.
Yeah, I was just curious. There's a lot going through my head as I've heard you speak. There's a lot of different options, right? Some are probably more expensive than others. Is that the case? Can you speak a little bit about, what do these things cost, the expense issue?
Well, there are a lot of factors that go into it, and to keep it high level depends on the valuation, how many partners, ages of partners, health of partners. They're all insurability factors, but also go to valuation, which speaks to Brad's aspect of the planning as well. So in lawyer terms, like Jesse said, it depends. So even with financial advisors, it can depend. So, that's really key.
The other thing as well, when you were talking about the valuation, to get to $500,000 on a business that has 10% margin, you're really talking about $5 million of top line revenue. And
right.
These numbers get big, and when you put numbers around them, it makes it meaningful. So I'm just curious, how does this whole thing fit into, how does it figure into estate planning?
It's a good point. You know, estate planning, if a longtime business owner is very successful, the likelihood is they've got a substantial value to their business. And, you know, you're going to be subject to estate taxation at some point, depending on how well your legal documents are structured. The government's always going to get their pound of flesh one way or another. And there's some cost-effective ways that takes into account. So, you know, from an estate planning standpoint, you need to look at maintaining, it's a couple of slides in because I was going to talk a little bit about executive benefits too, but for the sake of time, we may look at this. A business owner may have an estate tax exposure. Maintaining a lifestyle, all of a sudden, they've got to pay a couple $1 million in tax. How's that going to affect their lifestyle? And when you sell a business, you go from earning a paycheck because you're in charge to having a lump sum of money to make sure that it lasts and supports that same lifestyle that you had before. That may or may not be a realistic expectation because a business typically will pay for the college for 2 or 3 children, the vacation home, the vacations, the boats, the cars, and everything else that goes along with the lifestyle. That business has really been a very valuable cash cow. And that may mean more to the current business owner than it does to the future business owner. So it's something to keep in mind when it comes to that. The other part of it is if you have family members inside the business and outside the business, you need to provide a fair and equitable treatment of family members in there as well. That's a huge issue. And not that families argue over money at any point in time. I never see that. Do you?
Never heard of such a thing.
Yeah, happens all the time. So you have to find a fair and equitable way to do that. And again, a cost-effective way to do that is with insurance. And just to quickly back up on some of this planning, let me, you know, for a business owner, if you had an employee that showed up to work every day, never asked for a raise, never called in sick, never took a vacation, and were working 100% every day and did everything you asked for, how many employees would you want to have like that? They'd say all of them. Right. So typically for the average cost, for the cost of the average employee, you can provide the plans in place to protect the value of the business based on the valuation, enforce the legal agreements that Jesse has provided, and provide the security and knowledge knowing that that value is maximized in the business so that when there's a death, there's a divorce, there's a disability, the business owner retires, they're maximizing the value of their business. They've included their estate plan in this planning so that they can walk off into the next chapter of their life doing something new and know that their legacy is preserved by passing that business on to the next generation or to another owner, or they can create something new, whether it's charitable, civic, religious, educational. They can realize the full value of what they want to do, at the same time protecting their assets and enhancing the value of their life's work. And that's, to me, that's key. And that's why it's important for the three of us, Jesse, Brad, and myself, to have those professional advisors within your quiver when it comes to being a business owner. Quickly summarize to do that, you know, it's been said all along. We're all like-minded when it comes to this. Plan ahead. Business succession planning takes time. Treat your employees well. The better you treat them, especially your key employees, right down to the person sweeping the floor, the return on investment is invaluable. Take the time to work on your business while you're working in it. Put out your product and service. Let your advisors help you work on the important things that keep that business solvent, valuable, and marketable when the time comes that you want to step into that next chapter. Protect your life's work. You've worked hard your entire life to be successful. It's your most valuable asset, aside from what's between your ears, in most cases, that's your most valuable asset. You have to protect it. Take the advice of your advisors to help you along the way. It's the best way I can summarize it.
I mean, that seems to be it's been a common theme throughout our series, and I've learned so much. I want to keep the conversation going, but I've learned so much from each one of you. So I'd like to thank each one of the panelists that covered, what's a huge topic in a really short period of time. If you want to know more, you want to follow up with any of them, I'm sure they'd be happy. Just reach out to them. Their contact details are available. I'd like to thank all those that participated on the call today for your questions. We hope this has been valuable. I'll follow up with an email notice to all of you just to include the panelist details so you can continue discussions with any of them if there's something that sparked your interest. So this kind of concludes our fall series on surviving, thriving, and growing through the pandemic. At least for the fall, we hope to be back in the new year, so stay tuned for updates on that. And finally, I just wanted to end by thanking you all, and on behalf of the Business Advisory Group, that's myself, Dominic Grew, Warren Rutherford, and Lee Adelson. I'd like to thank you all for your participation and have a great day. Thank you.
Thanks, Dominic.
Thanks for having me, Doc.
Thanks, gents.